Today was just some weird anomaly that happened. Just a crazy sell off. We're recording this podcast on Thursday. So curious to see what happens tomorrow on Friday. It's already going to happen once you guys are listening to this podcast. But you made a pretty interesting observation today. You saw that crude oil was almost inversely correlated with the NASDAQ today. It's very interesting.
Yeah. So, um, I made this point up on X throughout as this was happening. I had oil up on a screen, and I was just watching the market, looking around, seeing what's going on, and I see oil start pumping like just out of nowhere, and automatically Nasdaq actually starts selling, right? Like around the same time, 2 p.m., right? Oil starts pumping first, and then when oil puts in um this 59 basis point candle and then start climbs again, and that's when the Nasdaq, it's like something started unloading here, and we don't know exactly yet what the deal is. I mean, apparently there's some geopolitical risk that's going on overseas in the Middle East, right? That's what they're saying it is right now. But what I have a feeling happened is, and this is my theory, and we'll talk a little bit more about why this type of move that happened in the market's a bit inorganic. But long story short, I think that there's probably not one, but a bunch of people running like a short energy trade, long tech trade, because they're betting that has run quite a bit. I mean, if we look at crude, right, like it's up quite a bit in a straight line. What, one, two, three? I mean, we literally got one, two, three, four, five. Uh, Thursday was the fifth day of straight gain, so there's probably a bit of short action going on there, and it's kind of building up into it. Like pretty much in right, like this type of run up, people are just getting short on the rips or even the dips. And I think they were offsetting that with long tech because what's been working quite well this year. And surprisingly enough, what happened was as this started ripping, tech started like again getting sold off. But if you looked at bonds today, they actually started going up. Now you can like the reason why this doesn't make much sense. Now people say, "Oh, it's flight to safety." Uh, buying crude is First off, buying crude is not the flight to safety trade. If anyone says it's flight to safety, they're talking about buying bonds, right? So let's take a step back and look at what's going on here. It's not direct confrontation, right? So like some people saying, "Oh, it's because of Ukraine joining NATO, war, whatever," right? Um, we take a step back. If bonds are getting a bid, it's obviously not inflationary risks because we're used to this type of price action in the market. The market's used to this type of selling, or at least everyone that's paying attention has this recency bias to 2022, right? When the market's nuke like this, it's pretty much okay. Someone said something hawkish. Someone nuked the market saying something like, "Oh, we're going to hike it." Like saying, for example, saying they're going to hike interest rates would probably be this type of price action, right? Something just outlandishly hawkish. That's what we saw in 2022, where the market kept trying to bet against the Fed, and the Fed kept slamming their foot down, and the market kept getting sent lower throughout 2022. Unfortunately, bonds going up kind of negates that, right? Or I should say, fortunately, because obviously we don't want to see a hawkish Fed this late in the cycle, or overly hawkish, right?
Well,
We already
there
have an
there
hawkish
wasn't
Fed.
even really any news that started this sell-off.
Some
Nothing
people
really
say
happened.
some people are blaming Kashkari, but that's all nonsense. That guy does not. That
Yeah,
guy
I mean, there's
has
no way that that's the reason that
yeah.
happened.
There's no way that him saying the Fed is not going to hike in. There's a possibility the Fed doesn't hike interest rates this year. That is not why this happened. Um,
It
because
definitely
again,
seems like somebody got liquidated.
it does, but like let's take a step back, right? So the theory behind the Fed saying that they're not going to hike interest rates, right? Or excuse me, the Fed that they're not going to cut interest rates. There was no talk about hiking rates, right? Let's take a step back. The Fed talking about not cutting interest rates. That means a higher for longer environment. If the market sold off on that, it would be meaning essentially that there's an environment getting priced in that's higher than what the market's been expecting. So in that scenario, you wouldn't see a bid in long bonds. You'd see long bonds puke. They wouldn't go up, right? Because if the Fed's not going to, if they're removing more hikes for a longer period of time from the market, well, the long end's going to lift. That's not what's going on. So you take a step back and say, okay, well, they're sold something off here, specifically in the NASDAQ. Miraculously, Bitcoin didn't even get touched, really. So again, another sign saying, okay, crude's up, right? So if we take a look at crude's up. Obviously, Middle Eastern conflict, so crude's going to get some sort of bid, and bonds getting up is a flight to safety. So the way I look at it when I see this type of action, as I was sitting in front of my computer screen here and I start to see NQ like this, the first thing I do is say, okay, the meta recently, or the last year or two in the market's been inflation, right? So the first thing I'm going to do is pull up crude just to get an idea. Okay, what's going on? Okay, I see crude pumping. I'm like, okay, this is before the headlines broke. This is how we break it down in real time. Okay, so there must be some inflation I risk. Okay, so bonds must be puking. Okay, I pull up bonds, right? And bonds are bidding. And I'm like, okay, so that's all bullshit. This is not about inflation. It's something else. And the thing is I don't know to what extent we're going to see. Maybe what ends up happening here is the first move down kind of liquidates a lot of late leveraged longs. And then we trigger stop run, which it seems like we did, where it just kept falling, free falling. Again, if this was on growth, if the market was concerned about growth, again, go to crude oil just to see what's going on. Crude oil, right? Inflation up. Well, if it was about growth, what would happen is crude would actually be going down, right? And bonds would be going up. But crude and bonds are both up, right? So that's telling you rates are down with crude going up. Again, not your normal dynamic market that we're used to seeing. So this is not so much growth related, at least not right away. Maybe it turns into something, we'll have to see, right? But this could spark, because all it takes is the market's so dynamic. Like, we can't just look at the market on a daily basis, right? And say like, okay, if we take out this low, then this low is definite. Because what ends up happening is the market progresses as the day goes on, or as the sessions continue, right? They compound on themselves. Maybe we're only dropping, 100 points in the NASDAQ, and then we hit a stop run. We push lower, we hit another stop run, right? And all these late leveraged longs start flipping, and then people are like, okay, it's time to add short exposure. And they start shorting, and then that's how the market works. It's very dynamic. So given that we've come down so much so quickly, the question we have to ask ourselves now is there going to be a continuation here? And
what do you think?
Well, I think that there's a possibility there is a continuation. Now, there's two things that can happen. Tomorrow, Friday, again, we're recording this on Thursday, we have the NFP numbers, non-farm payroll. There's a possibility that the market kind of got ahead of itself in volatility terms, right? Like VIX is already at 16.3. If non-farm payrolls come in favorable to the market, we could actually see volatility unwind lower and the market kind of squeeze, right? That's scenario one. Scenario number two is that little sell-off, whatever that was earlier today on Thursday, has just started a regular bull market dip. And I'm not talking like this. I'm talking like a bull, like something close to December of 2023, right? Where you pull back quite significantly to lower vamp. We're almost there, but these types of things can go a little bit deeper. I mean, we can go back into 2018 or 2021, right? Where like we fall down quite a bit and then we bounce. This is a more volatile period associated with post-COVID. So maybe it's not a good example, but even 2017, right? Like the market can trend down to Momo in bullish trends. It's not unheard of, and it's not that crazy to say there's a possibility. And it's not that crazy to say it's impossible, right? And I want to go back to a podcast from a couple of weeks ago where we elaborated that, look, the market's very easy in terms of understanding what to expect. If we take a look at SPY, right, we can see we're under mid-vamp. If we take a look at QQQ, we can see we are under mid-vamp. And what we said a few weeks ago up here, when the market was going higher, was as long as we're above mid-vamp, we expect new all-time highs with haste. Okay? It's very simple. As long as you're above mid-vamp, the new highs should roll through. Now that we're below mid-vamp, the doors for consolidation are much more open and acceptable now. Like the odds of us printing a new all-time high now are significantly lower, but the odds of this bullish trend changing aren't really shifting, right? It's just if you take a look at the market, as you can see here through our green trend showing it's a bullish trend, right? And bear trend, green trend. So we're in a bullish trend. As long as you're above mid vamp, you can kind of tally it up to short-term and long-term momentum, long-term being the trend, right? So it's long-term bullish, above mid-vamp is short-term bullish, double bullish, max bullish. Once you lose mid-vamp, you're long-term bullish, but you're midterm neutral. And in those periods of midterm neutral, price can certainly consolidate. And in a bull market, you kind of want to see that happen. Now, depending on how low we go, can we flip this? Can we have the top in? There's a possibility. Nothing's impossible. I don't think the top is in Bitcoin or equities as long as the regime stays locked in. And I
Yeah, I
said
mean,
this.
we're definitely going to need to see growth slow down significantly because growth is still strong. That's why we are in such a strong bull market. And
Correct.
seeing this consolidation is a good thing. We need consolidation. We need pullbacks. Think of it like the RPMs on a car. Like when you switch gears, the RPMs pull back. You got to pull back to head higher. That's how it works. And so
Right.
this could be the healthy pullback that we've been looking for, especially now that we're getting to that exhaustion phase. The market's basically been going straight up for the last few months. You need to have that pullback before you can continue higher.
And that pullback doesn't mean this is over. Like this is the whole important aspect of having a system that you trust. And that's what we have. We have a system that we trust, and the system helps us associate allocations for our RQF, our Radar Quant Fund. Now, the Radar Quant Fund has multiple strategies running actively in there. We have 3 strategies running live in the RQF. The RQF is kind of the umbrella that covers our 3 different strategies. And one of those strategies is what we call Aries. This is the strategy that goes back the furthest, all the way to 1991. Okay, this strategy has a CAGR. We run the strategy with leverage, 3 times leverage. It has a CAGR of 26 or 27% since 1991. So almost 30% a year for that many years, right? And then it has an average drawdown of 14% and a max drawdown of 43%. Now, unleveraged, it's a max drawdown of 16% and a CAGR of about 10%. So this is obviously a very robust model where it's running a 0.24 beta against S&P 500 since 1991. So it's not so correlated, right? And it has a Sharpe of 1.1 and a Sortino ratio of 1.5. So it's a decent, robust model, especially for a low touch model. Remember, we are not day trading. We are, so far this year, we've made 7 portfolio allocation adjustments. So we are not, and we're already in month 4. So just think about that. There's no day trading going here. So it's very low touch, the fact that we adjust when the model signals and we ride the wave throughout. So having these types of models are very important to lean on. So when we go back to look at SPY, like, oh my God, the biggest complaint now that we're going to see for a while until this gets invalidated is going to be bearish engulfing. Everyone's going to think, oh my God, it's over. Bearish engulfing, it's done, right? That's nonsense. Bearish engulfing for what? 2 weeks? We go down, maybe 3 weeks, right? Dip. And then when that high gets invalidated, then nobody cares about the bearish engulfing anymore. That's how this works, right? So it's only relevant until it's broken. So for us, we don't focus on these essential themes of engulfing candles, gapping candles, gaps to fill. Nonsense for us, right? Because we're not day trading. And even if we were, the edge is not there. What we're doing is we're focused more importantly on where the overall picture is going. Like you just said, Artie, growth. If growth is going to start materially decelerating from here, and obviously we had GDP now come in on Wednesday at 2.5%. So obviously, excuse me, not Wednesday, on Thursday, today at 2.5%. This is obviously this is above trend growth. So if we're still in an environment where even the Fed's models are seeing above trend growth, understand the market's even looking ahead than what this model is implying, right? This is just what the market sees now. The market's also going forward. So our system goes beyond what the Fed model is pricing, but this is just an easy guide. Look, we're at above trend levels of growth right now. If the market's going to fall, it should be a dip within a bigger bullish trend. That's what should happen as long as growth is persistent. So what we do is we take a step back. Look, we're allocated. The signals are what they are. We ride the wave. If we pull back and the signals do change in that pullback for whatever reason, we adjust accordingly. But if not, what ends up happening is these pullbacks wash out people on the way down and make them bag chase on the way up. What ends up happening is something very similar to, we can go back to December, right? So this is a bit more, I mean, we go to the NASDAQ, it's a bit more illustrated right here, right? Like, so everyone's like, oh, time to sell, right? It's a new year. This whole theme, everyone likes to say the market picks its direction within the first couple of trading days, right? Market's down. Oh, we're going lower.
Yeah,
Well,
that's
they end up selling
nonsense.
the stone cold lows of the year. And this bounce up here was, oh, we're not above all time, we're not above the prior highs. It's lower high now. That's the game, right? We pull down, lower high. Then you see how the market kind of skips up here? This is the bag chase getting initiated. This is people like, holy shit, I don't have enough stock. And then they're, the quote unquote bag chase. They have to chase back their bags that they got liquidated on the stone cold lows with. That's how this works on a psychological level. So when you look at the market like where it is, could we go down to 400 on QQQ? Yeah, that's possible. It's 7% from here. Would it be a tough ride? Yeah, but most likely before we get down there, something, if that bounce is not going to hold, the whole point of going down there with a bounce not holding, meaning like there's an actual issue, the system would have likely picked up on it and our allocations would have already shifted. So our system is early enough to prevent major drawdowns. Again, if we look here, unleveraged, we're talking 16% max drawdowns. The SPY max drawdown is 55%. On average, unleveraged the average drawdown is 4.44% versus the S&P of 9%, right? So again, these are back tests. These are not indicative of future results. Okay, this is just a back test. But what I'm trying to explain and get off my chest here is that the model is dynamic. And when you have a model that's dynamic like this, you need to lean on it. Because if you don't lean on it, you're fumbling the bag. The whole point of having the model, building the model, furnishing the model, tuning the model, and then basically computing everything is to be able to lean on it when there's times of uncertainty like this, right? People are scared. Well, we're not scared. The model says this. We say, okay, until the model changes, that's the game plan, right? And I want to kind of pivot now quickly into what's been going on the other side of the spectrum. The market's down today. That's the talk of the week so far this week. Maybe this changes tomorrow. Again, with NFP, we'll have to see. But the bigger concept in play has been inflation. Everyone's been looking at commodity prices, and we've been pretty vocal on X about this. And they're saying, I want to even turn off DDAP to make this a bit easier to see here. So everyone's looking at commodity prices, and we have crude energy here. Crude oil, excuse me, energy. So everyone's saying, oh, commodities are up massively, right? Inflation's coming back. This is a sign the Fed's lost control, and this has been a big topic. And I think that it's at this point in the cycle, very premature to say the Fed's lost control when all signs of their levels of restrictiveness are still there. If you look at forward policy and market inflation expectations, the yield curve, the Fed is still in a restrictive state, okay? And if we look at commodities, yes, they're up. There's no denying it. And even, matter of fact, crude went bullish trend a couple of weeks ago, mid-March, crude went bullish trend. So the price can drift higher. It's in a bullish trend. The regime's supportive of it, if you understand what I'm saying. The regime's supportive, the trend is supportive, it can grind higher. The problem with this whole crude oil trade at the moment is you're fighting the Fed. You have the Fed on the other side. So if you're long crude aggressively, you're betting the Fed is really not restrictive enough, and this marginal drift that we're seeing here is not going to be marginal. It's going to be more severe. If you're long crude, you're betting on taking out September highs and possibly triple digits per barrel, right? Now, if we look at it from an inflation perspective, what's the market looking at? Before we dive into the inflation swaps, just take a quick look at crude. Crude is at the same price as it was in October of 2023, as it was in November of 2022.
Yeah, at the end of the day, it really hasn't moved much.
It has not moved much. It's moved up off the lows. If you measure the stone cold lows, like, yes, if you go like this, oh yeah, it's up 27%.
Yeah, but
like,
so
again,
is everything.
Yeah, but I mean, let's go down off the highs. It's down 6% off the September highs still. Or actually, you know what? I'm sorry. The contract adjustment's kind of screwed up. So let me undo that. If you guys are using futures, remember to measure price changes, not on contract, just because what ends up happening is you adjust for the carrying cost. Long story short, when you adjust for contract rolls, you're implying that someone would have actually held crude from that time period as an investment, and we want to measure the price change as an inflation impact, not as an investment. So crude is down 7% off the September highs. 7% off the September highs. Just keep that in perspective when we talk about inflation, right? And let's roll into and let's have a discussion about inflation swaps, because that's where we're going to probably end up wrapping this podcast up on. But let's go there and let's just divulge what's happening here. So inflation swaps are about 13 or 23 basis points off the 2023 highs. 23 basis points on 5-year forward inflation swaps off the 2023 highs, right? So that means they are not above 2023 highs. They are not even close to 2022 highs. Okay, which instead of 13, it's 113 basis points off that. So there's been great progress made here on inflation. Now, if we take a step and we zoom out further, because this chart that I have on the screen here only goes up to 2021. Let's take a step back and let's look at the bigger picture. This goes all the way back to 2011. Inflation swaps are at the same point that they were in 2012. They're barely above where they were. We're talking about nine basis points higher than where they were in 2018. So when you think about the Fed losing control of this runaway inflation environment, understand that, can that happen? Yes, but you have to let the signal start appearing. You can't just say, oh, the stock market's up, so the Fed's not restrictive. That's nonsense. That's not real macro. That's retardio. Okay, you can't just look at the stock market and say the Fed's restrictive, the Fed's not restrictive. So you have to look at like what the market's pricing in. The reason the market's up is not because the Fed's not restrictive. It's because the Fed is restrictive and actually was able to bring inflation expectations down to target or just above target without causing a recession.
That's why they're actually achieving the soft landing, and that's what the market is bullish on.
Right. That's why the market's up. I mean, we can even just go to Qs, right? Why is let's just take the measuring stick, the old sturdy measuring stick. We're up 73% off the stone cold lows of 2022 because the market has so far been running a soft landing. Now, this brings us to the soft landing aspect. When we say inflation shouldn't materially accelerate from here, the first signs of it accelerating, what would we look for? Well, inflation swaps should be above 2.7. They should start breaking up. There should be clear signals here that, look, the market is uneasy about the environmental inflation. Another thing that should happen is the market should actively start to remove all rate cuts from the forward curve, and they should even start aggressively pricing in, or I should say moderately, not aggressively, pricing in some sort of a quarter of a rate hike. Some marginal type of rate hike should start appearing on the outer end of the curve. Not rate cuts, okay? And long bonds should shit the bed, okay? Since, quote unquote, the Fed has lost control, long bonds have gone nowhere. We should see long bonds new lows. If we start moving down...
I think a mistake that a lot of people make is they try to front run that. So what you're talking about right now, what you need to look for, people don't even want to see that. They want to front run that. Like once inflation swaps are breaking out past 2.7%, it's too late. It's already too late. You missed the trade.
That's the mistake, right? Because I know why they think that, because they think that they think that they need to make the contrarian bet to make the most amount of money in macro. And that right there is the first step down the golden brick road of being macro pilled. Right there, when you think you need to bet against, like you need to go against the grain aggressively and massively, kind of like, I think the closest assimilation we can make is to Michael Burry's 2008 GFC bet, right? Where like he was the one buying subprime credit default swaps when everyone was saying, oh, and he was fighting an uphill battle, right? Everyone thinks that's what you need to do to make money in the market. And that's nonsense, right? Like, let's just go back in time. Let's just go back here to 2020, right? Bonds go bearish trend here, 2020. It was very clear after this point, rates have upside potential. Bonds are bearish trend. Okay. So imagine you just said, okay, bonds are bearish trend. Now there's people that were fighting this whole thing, this whole entire time, probably beforehand, or even probably afterwards. Simple. Bearish trend, lower prices. Easy. Achieved. Bullish trend, possibility for higher prices. Well, we don't get higher prices, but we don't really get lower prices. We get this chop. Okay. We go back to bearish trend. possibility for lower prices. This is January of 2022, and everyone was saying the Fed was not going to raise anymore, or aka was transitory. No, we're talking about 200 basis points of rate hikes only, not 500. Well, bonds tell you beforehand, right? Look, bearish trends lead to lower prices. The odds of lower prices are now more prevalent. So again, you have a nice trade here. Great trade. Great. Boom. Bullish trend doesn't really materialize. Neutral trend. So it's simple. If you want to see a resurgence of inflation and a decoupling of Fed expectations and just a blowout from the Fed, you're going to, number one, you're going to need a bearish trend in bonds, and you're going to need to start seeing inflation swaps broaden up higher. Because if you see a bearish trend in bonds, right, and you see inflation swaps kind of just edging up, but kind of stuck here under like this in this 2023 range, again, you have to be careful for just price action chop. I mean, we've been neutral trend for some time. We could flip bearish trend and then go back to neutral, right? But if you start to see firm up in inflation expectations, the market start to really not like that bonds are going lower and yields are going up, then all right, time to reevaluate. Look, market can see some pain here with higher interest rates. But until that happens, don't sit here and try and front run something that has no indications of materializing just yet. Just because you think Powell said something dovish and he should have said something hawkish doesn't mean the Fed's lost control. But I'd like to wrap up the podcast there. If you guys have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com, where you can access our models on a daily basis and see how things update in real time.